Over the last few years, a lot of people overlooked dividend investing. People were investing into growth stocks, into EV companies, into space companies, into cryptocurrency companies, and we're kind of passing up on some of the more consistent investments, some of the more boring investments. And while I believe in cryptocurrencies and have been investing heavily into some of the growth stocks that I think have a very bright future, like Tesla, Google, Amazon, I've also been investing consistently at least $100 a week into a dividend portfolio. Now, I've done this since my YouTube channel really started, or since I started to grow a little bit on YouTube, and I've been consistent with this. Now my portfolio is just around $14,000, and it's giving off bigger and bigger dividends all the time. I want to look through it here today, look at some of the companies I have in it, look at why I started this in the first place, how it's going to grow over time, and what it will pay off in the future. How big will this thing grow, and what will the dividends be like? Also, looking at some of the top companies in it and seeing how much of those companies I'd have to actually own to be able to get about $60,000 a year in dividends, or $5,000 a month. And the reason I bring that up is $50,000 or $60,000, $5,000 a month, I think can definitely supplement most incomes and can make it so that maybe you can retire, or at least you can work part-time. You can be more selective with when you want to work, and can, I think, drastically improve a lot of people's lives. So we're going to look at it here today. If you like this, please hit subscribe. Let me know underneath the video if you like these dividend videos, because I don't do them too often. My channel is not very geared towards dividend investing, but I like to give updates every once in a while. I'll also put a link to M1 Finance underneath the video. If you signed up for it, great. That is what I use here, but there's no pressure. Just know that I think it's a good platform. It allows you to invest once a day, or if you get the plus version, you can go twice a day, invest twice a day, which forces you to not try to time the markets as much, which I think is good for these kinds of long-term investments. And when you sign up and deposit, I believe it's $100, you get some free money, and I get some free money too. Now, this portfolio, again, it's honestly one of my better investments over the last year, because so many of the different indices and so many different growth stocks and anything tied to growth has actually gone down. The return on this is 11%. You can see some of the bigger fluctuations have happened recently because I had more money in that account, and we've just had a very volatile year. So far, I have about $534 in earned dividends, which we'll go into in a second, kind of how that breaks down and how big some of the dividends are. But just know that the dividends recently are much more substantial than at the beginning. At the beginning, it was like a few cents here and there, but now they're pretty large, some of them. Now, going through some of the holdings in this portfolio, I have Vici on here. It's a REIT that's based in Las Vegas. I really like them for a variety of reasons, but the main one is I think their business is very sticky. The companies that are in their buildings can't move easily. It's not like some person that's working remotely at their job and they bought or rented an office down the street, right? These are large scale operations that have hundreds of employees, that have people that come to their specific building all the time. They know exactly where they are and they like to go there. Vici also has it in their contracts that rent goes up over time with inflation, or is inflation adjusted. So they are able to continuously get more and more out of their tenants. We have Apple on here. I'm pretty sure everyone knows what Apple is. Texas Roadhouse is a sit-down restaurant chain here in the US, which we'll look at. Microsoft, obviously a lot of people know what Microsoft is, very sticky business there too. Realty Income Corp, a real estate company here in the US. A lot of people like them because they give monthly dividends. Now, I don't really care about getting dividends monthly. It is nice, but I like them to diversify a little bit more into the real estate space. We have Starbucks as well, Disney, SCHD, which is a dividend ETF, and then Target, which we'll look at some of those here in a second. And the reason I started this in the first place was I wanted something that was easier to track and would be reliable. Dividend companies are pretty reliable. They like to keep their dividends. They don't like to slash them because a lot of people rely on them and they lose favor if they slash them or stop them altogether. They really have to have a good reason for it. One of my companies actually did slash their dividend over the last few years, Disney. But moving back to this, I wanted something that I could track consistently. And I started at 24 years old. I plan on doing this till I'm 60. If I get an 8% rate of return and invest $100 a week, I will have around $1 million at the end of that 36-year period. Now, only a small portion would actually be what I invested, $187,000. The rest would come from capital appreciation and from dividends. Now, I have upped this recently to $110 a week due to inflation, but I am planning to consistently add more every few years to this weekly portfolio that I'm investing in. Now, looking at a couple of the companies, Vici, very sticky business. The revenues have been growing. Their free cash flow has been growing. Their dividends are pretty consistently growing as well. You can see a couple of years ago, they have a dividend of 0.16 back in 2018, then 0.29, 0.3, 0.33, and then 0.36. That's per quarter. They have a dividend yield of about 4.6%. They have been acquiring companies as well. They have to acquire they've been acquiring real estate. They have to acquire real estate consistently to continue to grow. Now, the tricky thing with REITs is they can have growing revenue, they can have growing earnings, but you need to make sure that you actually, as a shareholder, get paid more over time for your shares, because they can dilute shareholders, they can take on bad debt, and they can continue to grow revenue and net income. But you need to make sure that those are deals that are actually accretive to the shareholder. They're actually good deals. So, for example, if Vici is able to purchase a piece of real estate in Vegas, right, and they can get maybe 10%, a 10% yield on that. They take $100 million and can make $10 million a year, and it costs them $6 million or something like that to be able to get that real estate, $6 million a year. That would be accretive. They would have to dilute or raise money or sell some more shares or something, right? But it would actually benefit all shareholders in the end. You want to make sure your companies are able to do that. Now, I think Vici has done a pretty good job of that. They've gotten some pretty good deals over the last few years and have been able to continuously become more and more accretive to the shareholder. Now, looking at Texas Roadhouse. Texas Roadhouse is a company that I think a lot of people overlook. I mean, there's one big YouTube creator that's talked about it recently, but when you look at the revenue, it looks like it's growing, but their EBITDA is kind of back and forth a little bit. Their free cash flow is back and forth a little bit, but once you bring it to annual from the quarterly, it's quite impressive what they are doing here. Now, their revenue has been growing consistently over the last 20 years, with the exception of 2020, where some people just weren't eating in restaurants. You look at this, their 10-year growth in revenue, compounded annual growth rate is 12.06%. Their 2-year is 12.1%. Their 1 year is 44.44 because of this big drop back here. But you can see the 5-year also around that 12%. They've been consistently growing, very consistently growing over the last 10 years. EBITDA, same thing. Dividend, same thing. Free cash flow, going in the right direction too. Earnings per share, net income. Their return on capital employed is also very high for a pretty boring business, all things considered. When you look at this, return on capital employed is basically how much they can give you with money that's now going into the business. So if I were to give them $1, they could return 16% of that. They could return 16 cents essentially. With their reinvesting, they're able to return pretty significant amounts of money, especially for a business like this. Usually with software as a service companies or higher growth companies, some of these higher multiple companies, they're able to give you 20, 30% maybe. But some of the more boring companies are around 6, 7, 8, 9, 10%. Some of the dying companies are less than that. Some companies that just take your money but are actually hurting shareholders consistently. Really, the cutoff rate is about 8%. You want over 8% return on capital employed, and that's a little bit basic, but that's a kind of a interesting, or I think a good rule of thumb. Now, over the last year, they did have to raise shares a bit, but before that, they were able to cut down on the shares outstanding. They were able to buy back shares. They also have a growing dividend, about 10 to 15% a year. As you can see, the 10-year is 16.49%, the 5-year 16.98%. Consistently growing their dividend. Now, their dividend does not pay quite as much as a lot of other companies in this portfolio. Like Vici, again, was 4.59%, while Texas Roadhouse is 1.86, but it grows very consistently and very quickly. Their forward PE is about 20. Now, moving on to the next company, Microsoft, obviously a very different company, very large company that has high margins, is usually priced pretty expensively, around 27 right now after selling off a lot throughout the year. Now, they are consistently able to buy back their shares, also consistently able to pay higher and higher dividends. Now, they pay the smallest amount of these three companies we're looking at, only 1.11%. Now, they are able to continuously grow this about 10% or 11% a year, but they are starting from a pretty low yield. Now, they have a great balance sheet. They have a sticky business, especially with their cloud business, which is growing very quickly as well. Their price to free cash flow is historically pretty cheap for this company, and it's just a very consistent grower as well. Now, breaking these companies down a little bit more, how much do you need to make significant dividends? So I'll show you my dividends first, but then we will break down how much it costs and how much you need right now to make $5,000 a month. And then we'll look at the cost to earn $60,000 if you were to buy right now, and then wait 10 years. So if you're able to buy the shares right now, some of these are growing their dividends faster. So we'll look at how that changes over time. But first of all, let's look at something fun. Let's look at these dividends in this account. Going back to the beginning of this account, we can see the dividends for 40 cents, 27 cents, 62, 26, 27, $1.14, which was pretty big back then to get over $1 in dividends. On January 6th of 2022, $18.20. So that was at the beginning of the year. Then another one for $7.56. Packer, $5.10. Qualcomm, $1.59. So you can see those are pretty big compared to the beginning. And now they're even bigger than that. Let's look at the last Vici, $57.81. We have $3 coming monthly from Realty Income. JP Morgan Chase was paying me $19. Apple, $4. Microsoft, $2.74. SCHD, $4.59. And I've changed the portfolio a little bit recently. If you want to follow along and know exactly when I sell, you can check out the Patreon, but I don't change it too often. But you can see that these dividends are much more substantial. We're looking at a higher amount now than we were a couple of years ago, and that will continue to grow. I wouldn't be surprised if in the next year or two, we get something that's closer to $100 for one dividend from Vici. And if you want to know how much this portfolio makes each year in dividends, the dividend yield is about 2.65% right now, which means I make about $368 a year in dividends, or about $30 a month. And as time goes on, this yield will get higher and higher for what I've invested, because these companies do give consistent dividend increases and dividend bumps. Now, what if you want to earn something more substantial, maybe $5,000 a month? How much would you need of these different companies to be able to earn that? Now, of course, you want to diversify, and this is just a fun exercise, right? You wouldn't want, if you had $1 million, to put it all in one company just for a dividend. You want to actually make sure that it's a growing business, that it's got a sticky business model, that's going to be continuously a good investment, not just shoot off large dividends, because that's something that a lot of people get into pretty big traps with. They just buy something that's a very high yield without really making sure that the underlying company is good. Now, if you wanted $60,000 a year, though, in dividends from Vici, for example, you need about $1.28 million in it. From Texas Roadhouse, you need about 3.15. And then in Microsoft, you need $5.3 million just for $60,000 a year. So you don't necessarily buy Microsoft just because it pays a 1% dividend. That's probably not a good reason to buy it. You expect these to grow in the future, and that's what we showed here. They're able to continuously grow dividends. They're able to continuously become more profitable, thereby allowing them to continuously raise the dividends. So that growth rate is pretty important. If we look at the 10-year yield on cash, so basically if you're able to invest right now, looking at what these companies have historically been able to raise their dividends by, we can look at how much they yield in the future if you are able to invest money right now. So right now, Vici gives a 4.68 dividend yield, but if you waited 10 years, what you put in now would give you actually about a 10.78% yield. So you put in $100, you get $4.68 this year, but in 10 years, if they're able to continuously raise the dividend by the same amount that they did for the last few years, you get $10.78 in dividends. Now, Texas Roadhouse starts under 2% dividend yield, but remember, they grew by a substantial amount more than these other companies. They're able to grow 16.49% over the last 10 years. If you invested $100, you get $1.90 now, but in 10 years, if they're able to continuously grow by this amount, you get $8.76. Now, Microsoft would be about $3.33 in 10 years. So because it is down at 1.13 and it actually has a lower growth rate than something like Texas Roadhouse, you have a little bit lower yield in 10 years. Now, they pay less in dividends than these other companies. They don't focus on dividends as much, and you have to look at other metrics as well. But I still think that these are 3 solid companies to be investing in now that will yield more in the future. So if you're able to invest now and try to get $60,000 in dividends in 10 years, how much would you have to invest? For Vici, $556,000 today would get you about $60,000 in 10 years, assuming they continue to raise their dividends consistently. For Texas Roadhouse, $685,000, and for Microsoft, $1.8 million. Now, you would also get dividends in the meantime that you could reinvest, so it could be a little bit lower if you're willing to reinvest them, but you can see how this works over time. You don't necessarily have to have super significant amounts of money to be able to put into these companies if you're willing to wait longer to get some of this yield, right? And I realize $556,000 is still a lot of money, but if we raise this, if we're thinking that Vici is able to raise by the same amount for the next 36 years, for example, right? Your 36-year yield on cash would be nearly 100%. So if you put in $100 today, in 36 years, if they're able to continuously grow, they should pay you $94.28. So you can see how that can change over time. Same thing with this. If we go to Texas Roadhouse, of course, there is a law of large numbers, right? It will be harder to grow probably for these companies in 35 years if they're doing the exact same thing, unless the population grows substantially and can continuously be able to compound at this rate. They will most likely slow down over time. And for Vici, there's only so much real estate. But you can see how this could be a good example, though, of how you should think about things, right? 36 years into the future, we're looking at 463% yield on cash. So you put in $100 today, $463 in dividends in 36 years. Again, maybe a little bit unrealistic with some of these companies, but you can see where I'm going with this, right? As time goes on, the yield on cash grows higher and higher. Now, I will continue to invest into this portfolio. Companies might change a bit, but I like to pick companies that have a wide moat that I don't see in the news every single day. They're companies that just continuously work in the background, are at good valuations, are going to continue to be relevant to the industries that they're in, and continuously grow.